The RBA just cancelled interest rate cuts, and if you're wondering what this might mean for property prices, you need to watch this entire video because the answer, it isn't what most people think. Right now, thousands of investors are making a decision based on yesterday's headlines, and that decision, it could either put them years ahead financially or leave them watching from the sidelines with serious regret. Look, I've been investing in property now for 23 years, and over the last 9 years, I've helped over 500 investors navigate moments exactly like this one. And what I've learned is that the people who make decisions based on what they read on the news end up with completely different outcomes than the people who understand exactly what's happening, because something is moving property prices right now, and it's got nothing to do with rate cuts. So today I'm going to show you what's really driving prices, why most investors are about to make the wrong decision, and what you need to do before this window closes. Now, when news like this breaks, most people immediately think the same thing. They think if the RBA doesn't cut rates, then property prices won't rise. It's just that simple in their minds. No rate cuts equals no property price growth. But if that was really true, how do you explain what happened in 2023? As you can see here, we had 5 interest rate hikes in 2023. The RBA was aggressively hiking rates, and almost everyone predicted a property crash. Now, if you've been with me long enough, you know I went on record multiple times saying that property prices would rise and rise significantly. Now, many people thought I was crazy. I got criticized heavily. But what happened? Prices went up anyway. So it's clear something else is happening here. And to understand what's actually happening, let's have a look at what really drives property prices. You see, most people obsess over interest rate decisions, and they think that's the only thing that matters. They believe the Reserve Bank policy, well, it controls everything. Well, to dispel that property myth, let's have a look at this chart, which tracks interest rate movements versus property price movements. And what do you notice? Well, for example, from 2002 to 2006, interest rates increased, and after a very slight dip, what happened to property prices? They rose as well. Then in around 2008, 2009, when interest rates were cut, property prices actually fell. In fact, as you look through the chart, what you can see is there isn't actually a direct correlation between interest rate movements and property price growth. But here's something else that's even more important. Have a look at the number of times property prices actually fell. That means the rate of growth was less than 0. We've got data from over 20 years here, and yet the number of times that property prices fell was all of 4 times. And the biggest price falls were just after the GFC and just after the COVID pandemic. We're looking at price falls of less than 4%. Now, prices in most areas around the country have increased by more than 4% since January. So even if there was going to be a price correction, it would have to be because of some sort of major economic turmoil like the GFC we had or the pandemic. And yet, if prices fall by only about 4%, that'll probably take them back to where they were maybe 3 months ago. So it's clear, interest rate movements, they are not the major needle mover for property prices. Instead, property prices move according to 2 fundamental forces, supply and demand. That's it. Now, of course, interest rate movements can influence demand. For example, when interest rates rise, people's borrowing capacities decrease, so they can't afford to borrow as much or pay as much for property. But when interest rates fall, then people's borrowing capacities increase. They can afford to borrow more. They can afford to pay more for property. But still, that's just one factor among many. Right now, though, we're seeing a perfect storm where supply is falling off the cliff. I'll show you why in just a moment, while demand, that's surging. So when you have fewer properties available and more people competing for them, there's only one direction prices can go, regardless of what the RBA does. So please, Stop making investment decisions based on headlines about interest rate cuts or interest rate holds or scary headlines about, oh, is the RBA going to increase rates? None of that really matters. Instead, look at the actual supply and demand metrics. That's where the real story is. Now, I have spent the last 3 days going through the data, analyzing supply reports, migration figures, building approval statistics to bring you this analysis. And I've put this all together in a single metric you need to check before investing in the current market. Now, I've created a free checklist to help you with that. It's got every data point, every warning sign, and every green light you need to look for. You can grab that using the link in the description. And honestly, if I was you, I wouldn't commit a single dollar towards investing in property without going through that checklist first. You can grab it for free in the link below. Okay, so let's start with supply, because what's happening right now, it's actually shocking. Most people seem to assume that, well, there are plenty of properties, you just got to look hard enough and long enough. They think the property is balanced, and some people even seem to think the market might even be oversupplied. The reality is we're facing a severe supply shortage. Property listings, so the number of established or already built properties available for sale, they are down significantly compared to historical averages. As you can see from this data, when we look at the national data, you can see that the number of properties available for sale is much less than it was a few years ago, despite the fact that our population is actually much higher than it was a few years ago. If we look at a couple of our major capital city markets, let's have a look at Adelaide, for example, or Brisbane, you can see the same thing. The number of properties available for sale is much less than it was a few years ago, while there are actually more buyers. Can you start to see what's happening? We have more buyers, less properties for sale, because property owners are holding on to their properties for longer, which means the demand versus supply gap is only getting bigger, which means that based on fundamental economic theory, prices are only going to go one way. But here's what's even more concerning. Building approvals. While the government is talking about, oh, they're building more homes, if we look at the data, the number of properties being built today in 2025 is less than it was 8 years ago. That's right, we are literally building fewer homes today than we were in 2017, despite, like I said earlier on, our population being much larger. And according to recent data from realestate.com.au, more and more sellers are actually too scared to sell. Why? They're worried about where they're going to live next, where can they buy, whether they'll be able to buy back in later. So properties that would normally come onto the market, they're actually staying locked up. So when you're evaluating whether a particular area makes sense to invest in, check the total listing numbers in that area over the past 12 months. Compare it to the period in previous years. If listings are trending down while the population is growing, that's a strong supply side signal in your favor. Now, while supply is shrinking, demand, that's doing the exact opposite. Most people seem to think that if interest rates stay high or they don't fall, then demand will fall as well, because they assume that fewer people can afford to buy, so competition should ease. Well, while that does make sense, the data actually tells a different story. Migration levels, they're running higher than the long-term average. We're bringing in more people than we have homes for them to live in. And you can see the impact of that everywhere. Rents are being forced up because there simply aren't enough properties. So now, of course, rents are not rising as fast as prices are, but rents are definitely on the increase. Smart investors, they are realizing this, and they're targeting the areas where they can get most price growth as well as maximum rental growth. Because after all, if you're serious about creating freedom through property, you want your net wealth to grow, but also you want your cash flow to improve as well, right? So look at the rental vacancy rate in your target areas. Look at how much rents are rising. If the vacancy rate is less than 2.5% and you can see rents climbing year on year, that's telling you demand is strong. It's going to support both price growth, but also rental growth. But apart from just that, the federal government is also pouring fuel on the fire when it comes to demand. I've spoken about this in the past. We have the first home buyer incentive schemes. People don't realize just what kind of an impact that's having on the property market. They seem to think that these first home buyer schemes will just help a few young couples get started. They don't realize just how much these programs actually move markets. I mean, according to Westpac, they have seen a 150% increase in loan applications from first home buyers since the latest incentive schemes were announced. Now, that's not a typo. 150% increase. And realestate.com.au reported that first home buyers are driving prices up by as much as $100,000 in just 6 weeks in some areas. Now, think about what this means. You've already got low supply and high demand. Now the government is making it easier for people to enter the market with lower deposit requirements. You're adding thousands of new buyers who previously couldn't compete. They're coming in with urgency because they don't want to miss out. They want to buy as soon as they can. This creates even more competition for the same limited pool of properties. It really is like adding petrol to a bonfire. So if you're looking to invest, pay close attention to areas that are affordable for first home buyers, typically properties under around $1 million depending on the state. Now, these are the price points where you'll see the most competition and the strongest price pressure from this new wave of government-backed buyers. So now let's have a look at why this rate pause is actually your opportunity. You see, most people are treating this rate pause like it's bad news. They think no rate cut equals no more property price growth. So they're gonna sit on the sidelines and wait. But let me explain to you why that could actually be perfect for you. First, some of the factors that actually pushed up inflation recently, they're temporary. They're gonna wash out of the data in the coming few months. When they do, rate cuts will likely be back on the table. But I don't see any scenario where rate cuts are going to increase from here. Worst case, they stay where they are. And this rate pause, it's going to scare off at least some of your competition. You know, the people who make decisions based off media headlines, those investors, they're going to hesitate. They're going to wait. They're going to sit on the fence waiting for the perfect time. Meanwhile, the supply and demand fundamentals we just talked about, they haven't changed. Properties are still scarce. There are still more buyers than available properties, but maybe you might have a little bit less competition from other investors or maybe other buyers who just got spooked by the news. What would I do here? I would be using this window of opportunity. So while so many others are waiting and seeing, I'd be trying to secure an investment property before the next wave of demand hits. Because when rate cuts do come back, and they will come back on the table, you're going to see so many other people rushing in at once, and you'll again be competing with all of those buyers. Now look, it's one thing to understand what's happening in the market. It's another thing entirely to know exactly where to invest and how to structure your purchase for maximum returns. So if you want to take advantage of this window of opportunity, but if you want to make sure you're doing it right, book a free call with a member of our team. We'll look at your specific situation. We'll show you where the opportunities are right now and walk you through our proven passive investor approach. The link to book your free call is in the description below. But there's something else I want to add to this. Even with perfect timing, your success still comes down to one thing: location. Because the right strategy in the wrong area will still lose you money. So watch this video next where I reveal the truth about how some investors, they're actually getting filthy rich from the housing crisis, while others, they're losing everything or just missing out. You'll see exactly which approach makes a difference on this video.